Hey guys, and welcome back to the Finance Now podcast. This podcast is purely for informational and educational purposes, and it's my way of sharing my knowledge, research, and opinions with you. I'm Anurag Birla, and before we start off with this week's macro debrief, just want to apologize for the slight delay in the upload and recording of the episode. I was having some technical issues which caused me to have to do it a day later than I had initially planned. So yeah, just wanted to apologize on that front. But now starting off this week with macro debrief. So what did we see last week? I guess, we saw inflation numbers come in. CPI came in just below consensus of 2.8%. It came in at 2.7%. And we saw core CPI come in slightly higher than consensus, which was 3.1% versus 3.0%. I think the big surprise in all the inflation data came in around PPI, right? The month-over-month reading was 0.9% versus consensus of 0.2%. And while you look at the CPI numbers, right, they seem fine. Maybe just a slight miss here and there, but PPI was a big miss. And that definitely should be something that is concerning, or at least in my opinion, more concerning than what the market took it to be, right? PPI is typically seen as a leading indicator for CPI, right? Because it's at the producer level. It's one step before it reaches the consumer. So perhaps, I guess the takeaway here is at the producer level, we are starting to see some of those tariff impacts, which aren't yet being passed through to customers, but at some point, maybe. It's safe to assume that at some point, companies are going to realize that, hey, these costs are going up, our margins are going to get eroded, and we're going to start passing these prices or these costs through to the customers, right? So this piece of data is something that definitely investors should be on alert after reading this and should definitely be monitoring, especially the way Powell speaks at Jackson Hole this coming week, right? On the other end, we saw the numbers for retail sales come in, right? Retail sales came in at 0.5% versus a consensus of 0.6%. Core retail sales, which excludes the autos, gas, building materials, and food services, that came in right around consensus at 0.3%. And retail control, which was a more targeted form of core retail sales, that came in slightly higher at 0.5% versus consensus of 0.4%. So overall, I would say consumer activity still looks fairly decent, right? But this doesn't tell us that much at the moment. We've seen consumer sentiment strengthen from the lows a couple months ago. And, while this looks fairly decent on paper, it's just data to note, in my opinion. There is resilience, but there is also this element of caution as well within consumer spending. And obviously, I think the key here is just monitoring inflation and unemployment as two of the largest Fed mandates if we kind of want to have a picture about what's going to happen with rate cuts. I guess, overall, the inflation data does paint a bit of a mixed picture as to what the Fed should do. And, as I mentioned, this next week is going to be key, especially the speech that Powell's going to give at Jackson Hole. We should get more color on what the rate expectation path should look like. And I know that, cuts are being more or less priced in at the moment. And if that is the case, right, if a cut is to happen for September, I just personally wouldn't bet on more than 0.25%. The PPI data, just to me, looks a lot more worrying than the market may have reacted. And I think a cut may be warranted, sure, but I'd be a lot more wary of the magnitude of that cut with this inflation information and data. But now moving away from macro, moving on to earnings for the week. There's not going to be too many companies here. Just want to talk about two earnings and then obviously an IPO that happened earlier this week that probably took a lot of the news that people have been following. So I wanted to start off with a software company called Monday.com. I'm sure everyone's seen the YouTube ads that they had promoted. Monday.com being their software SaaS business, the CRM, right? They reported second quarter earnings and revenue that that topped Wall Street consensus estimates. So they reported revenue of $299 million for the quarter, which is up 27% year over year. Non-GAAP operating margin of 15%, a gross margin of 90%, and their full year revenue guidance came in between 1.224 billion and 1.229 billion, which is an increase of 26% year over year. And guidance also for non-GAAP operating income came in at 154 million, came in between 154 million and 158 million, which was a 13% margin. So slightly lower than what they reported for Q2. If you look at how their business is growing, their enterprise segment remains the fastest growing aspect, right? They had a record net new customers paying over 100,000 annually. We saw that Monday CRM reached 100 million ARR in recurring revenue, and this was predominantly driven by both seat expansion and higher contract value annually. And we see Monday.com's distinct go-to-market strategy that is helping their services scale, right? We saw AI adoption accelerated with this firm. They launched new products such as Monday Magic, Vibe, Sidekick. Initial monetization of AI features for them began in Q1, and I guess these new features increases the expectation for AI related revenue in 2026. Now, amidst all this, the stock tumbled. And when I say tumbled, I mean it had one of the worst days, if not the worst day, in its trading history. It was down 27%. On the day of earnings. So why did this tumble happen? Where did this much disappointment come from, right? Results look pretty decent. And I think a lot of the disappointment comes from revenue forecasts for the third quarter. Right, the company saw between 311 million and 313 million, whereas the street was looking for the higher end of that range. They were looking at 313 million. Now, I'm not sure this warrants that big of a drop, but I think there were other problems that I'll get to. I think, one of them was the fact that executives spoke to problems that the company has seen due to changes in Google search, right? Specifically with SEO and the way search is changing structurally. Retention, though, for Monday.com remains very strong for the business. And the drop that they see because of this Google search change is just on volume, because Google are experimenting with AI, and as of now, it's not that significant for the higher quality customers of Monday.com. So essentially what they're saying is that fewer people are clicking on their website from Google search, but the people who do click want information about the company and its services. So the quality of customers remains pretty strong, and the quality of that traction remains strong, even if overall traction has maybe reduced. And I think management did give some color on the softness, right? They did mention that these changes seem temporary, and they did instill a good level of confidence that they were on top of it, and they do believe that this is temporary and that this won't materially change their business. But this leads me to my belief, right? Ultimately, I think the drop is due to a mix of reasons, not just these two that I've mentioned, which is the revenue forecast disappointment and the Google search scare, right? I think it's a lot more than that. I think structurally people are scared that SaaS businesses are going to become somewhat redundant in the age of AI, or at least AI is going to cause their R&D to increase drastically and reduce their ability to maintain margins, and hence lower valuations. And I think while it is a fair concern, I do think the businesses that are able to leverage AI instead of compete against it are going to stay relevant and are going to stay necessary for customers, right? Because it's that age-old question of build versus buy. And I think a lot of companies where their core competency is not to provide software or build software like this, they're going to continue to outsource, right? Because they're going to focus their resources, their time on building what they are good at versus building their non-core competency. So I don't necessarily think that these SaaS businesses are going to become redundant, especially the solid ones, right? And I think another reason that the stock dropped is because people are wary about IT spend and the effect that tariff uncertainty is having on IT spend, right? Overall, looking at how drastic that drop is, I do believe that there will be a shorter term technical bounce from these levels. The stock seems extremely oversold on certain technical metrics, but even for the longer term, to me, Monday.com remains a solid business. The results were in no way as drastic as the market reaction showed, right? Management remains strong, as they have been throughout time. The company is resilient. The edge that the company has in pivoting into a more AI-driven solution is strong, and they've been doing that already. I think monetization is just starting. And I think that these temporary headwinds that they see, overall, the company and management are going to be able to navigate these headwinds very successfully, right? I'm going to leave this Monday.com earnings discussion with one comment that I heard from the CFO that really stuck with me. In a volatile market, businesses are prioritizing efficiency, and that's where Monday.com delivers. This, to me, pretty much encapsulates, I think, the confidence that both management have in the business and I have in the business, and the confidence that I have in the solid value that it delivers to clients, which makes me believe that, this business isn't failing tomorrow, right? They're not going to stop growing. I think they're going to continue to grow at a very, very solid rate, and a better rate than the market is currently giving it credit for. Now, moving on to the second earnings that I wanted to cover this week. This was Circle, right? Circle obviously had its moment with the IPO coming in at $31 a share and then soaring up to about $270, I think, and then settling back down to what is now close to that $150 region. So ever since their IPO, they reported their first earnings as a public company. Overall was pretty solid. We saw USDC, which is Circle's core stablecoin, what they're kind of known for, grew to 61.3 billion in circulation at the end of Q2, up 90% year over year. And this accelerated to 65.2 billion as of August 10th. On-chain transaction volume reached 5.9 trillion in Q2, which is up 5.4x year over year. They launched new major products, right? Circle Payments Network, Circle Gateway for seamless cross-chain USDC experiences, and they announced ARC, which is essentially a new layer 1 blockchain using USDC as native gas, launching in the second half of 2025. Essentially what this means is ARC is designed to be a network for stablecoin payments, FX, and capital markets applications. Looking at their total revenue and reserve income, that rose 53% year over year to 68 million. Other revenue, which is mainly from blockchain partnerships, that increased 3.5x year over year to 24 million. Adjusted EBITDA was up 52% year over year with a 50% margin. So looking at Circle, the company obviously has a lot of tailwinds with this current administration. They're very crypto friendly, and because of that, they've seen a lot of engagement from the financial system, payment partners, infrastructure partners, etc. So they do anticipate, in terms of guidance, other revenue of 75 to 85 million, right? Their adjusted operating expenses are forecasted to come in between 475 million and 490 million, and their core model expects multi-year USDC growth at a 40% CAGR, which is high. Now, obviously, there are valuation pressures with these growth rates kind of priced in. There are valuation pressures, right? Revenue beat and EPS miss in their current quarter means that the market will likely look at Circle's growth rate and trajectory with a little more scrutiny. I do think one thing to note about this company is that it is perhaps more sensitive to rates than people may initially figure, right? 96% of their revenue is tied to interest income from reserves. So earnings are vulnerable to a decline in US interest rates. Now, if the Fed cuts rates or, for some reason, like yield restrictions are tightened by regulation, their core profitability could decline sharply. And this would, pressurize the bottom line. It would challenge how sustainable their earnings can be. And I think that's what we're expecting, right? In terms of what the Fed are going to do, we're expecting rate cuts from this point on. So with that in mind, my opinion hasn't changed much since the days of the IPO. I still think it's a great company with an amazing opportunity that I just unfortunately feel at these levels is priced for very little room for error. Not something I'm comfortable with, as it's hard to say that there is a margin of safety here with this opportunity of investing in Circle, right? Of course, this may turn into a name like, Palantir that just goes to the moon and the fundamentals don't necessarily matter or the multiples don't necessarily matter. But I just think at current levels, the company is priced for very, very little room for error. So I think it's one that I would rather continue to monitor their performance through rate cuts and further quarters and see if, they continue to impress fundamentally, continue to grow at the rate they've said they can. And if so, I think, it could be a position that I'd be interested in getting into. I think the last story of the week that I wanted to touch on is also a crypto related story, and it's around the IPO of Bullish. I won't go into too much detail here because they didn't really report their earnings, but I just want to touch on what the company really does. Essentially, it's a crypto exchange, just like Coinbase, Kraken, Binance, but it's predominantly made for institutions rather than retailers. Now, Bullish also own CoinDesk, which is a media asset for them that provides information and prices on the crypto space. So, any crypto-related news, CoinDesk is a good place to read. Now, the company is backed by Peter Thiel, and their core focus, I guess, is on blending decentralized finance protocols with the security of a centralized financial system. Now, their target demographic is really the high frequency trading firms, algo trading firms, market makers, hedge funds, and the likes of those financial institutions. Looking at their IPO, the stock soared 83% on debut, right? They, much like many other crypto firms, these guys are looking to take advantage of favorable regulations under the current administration. Now, I think the most interesting thing about this company is the fact that they're quite focused on institutions rather than retailers. And I would like to draw up on a video I watched of Tom Farley talking about the business, right, on the day of their IPO. Now, Tom Farley is their CEO, and he did mention that the last 10 years or so of crypto was really driven by the retailer, right, which is true. But this next wave is going to see that increase in institutional adoption and volume, which we're actually already starting to see, right? In the last few years, we've seen the likes of ETFs come through. We've seen now a lot more regulations come through in a much more favorable manner for cryptocurrencies and blockchain technology in general. So we are seeing that this institutional adoption, the systemic shift is starting to happen with regards to crypto as an asset class. And if you do believe this to be true as a listener, as an investor, Bullish could be a good company to own, right? The only thing, much like Circle, is around value again. We're in a very, I don't want to say hyped, but we're in a very bullish crypto and IPO market, which is ironic with the name. But this doesn't necessarily make for the most sensible valuations at all times, right? We've seen IPOs be extremely hot with Figma, with Circle, and with Bullish too, right? So with this stock, I'd give it time. I'd let the stock settle, find a more reasonable fair value that it trades at, and perhaps then look for opportunities after maybe a couple of quarters of earnings too, and you start to see the fundamentals change, the numbers grow. And if you want to look at it from a growth perspective too, I think it would be smarter to do so after a bit more information and time, rather than very, very early days where a lot is just driven by pure sentiment, right? So I do like this company, but again, what I'm going to be watching out for and continuing to monitor, and maybe even taking a position up at a much later date, provided that I see what I would want to see from a company of this opportunity set and of this offering, I guess. And on that note, that kind of wraps it up for today's episode. I would like to remind everyone that anything I say is not formal investment advice. It's purely my opinion and is for informational and educational purposes only. But with that, I thank you for listening. I'm Anurag Birla, and this is the Finance Now Podcast.